Hi, my name's Alex Rice, and I'm a financial advisor with Gearhart Associates in Cincinnati, Ohio. Welcome to our new series, One Chart to Rule Them All. We'd like to share with you our current favorite chart, which we're using to guide our economic outlook and investment strategies for the next few years. This is a chart comparing the 5-year annualized return based on the starting unemployment rate and price to earnings ratios since 1948. Unemployment rate here is used as a proxy for the overall health of the U.S. economy. The PE ratio stands for price to earnings ratio. It's a way to figure out if a company's stock is a good deal or not. Here's how it works. Price. This is how much one share of the company's stock costs. Earnings. This is how much money the company makes per share in a year. To get the PE ratio, you divide the price of one share by the earnings per share. The PE ratio of the S&P 500 in December of 2024 was approximately 26, and our unemployment rate at that time was 3%. We can see from this chart that investing funds at this point has historically resulted in an average 5-year return of less than 0. That doesn't necessarily mean that every year over the next 5 years will be negative, but the S&P 500 will likely yield a negative annualized return again over the next 5 years. If we look at where the S&P 600, aka small companies, rank, we'll see a slightly lower PE ratio and historically slightly more favorable returns in the orange dots, so averaging 0 to 5% annualized over a 5-year period. What does this all mean? Basically, this chart shows us a couple of things. Where you start matters. When the economy is favorable and stock valuations are high, you have limited upside. That's why we like to say you make most of your money in a bear market. You just don't realize it at the time. Meaning when the economy is doing poorly and valuations are decreased, you tend to see better returns. Another interesting point is that if you plot this same data but only use 1-year returns instead of 5-year returns, there is very little correlation. The dots are everywhere. So this reiterates the point that we don't know what next year is going to bring, but we do think that over a medium-term time period, we're not likely to see the same double-digit returns we've become accustomed to. We invest client portfolios with a diversified mix of stocks, bonds, and other asset classes, so we aren't putting all of your eggs in one basket. This chart shows us the importance of staying diversified, as we don't know what asset class is going to perform best each year. So we'll continue to become slightly more conservative in 2025, but we won't make any whole cloth changes to your portfolios. As always, we're focusing on your unique goals and your unique profile. We don't think there's a one-size-fits-all approach, so be sure to contact us with questions for your specific situation. Thank you for watching this video, and as always, let us know if you want to discuss further.